Welcome back to the Deep Dive. Today, we are opening the vault on financial mastery. And look, if you're listening to this, you know you're navigating what feels like a high-tech, high-risk maze these days.
Absolutely. The markets move at, well, algorithm speed. You've literally got flying robots trading at the speed of light, it feels like.
And the pressure's just constant, isn't it? Every day there's a new headline, practically designed to make you panic.
And 1,000 voices telling you exactly what you should do with your money.
Yeah.
And honestly, that noise, that's the real enemy. Our mission today is to cut right through that perpetual din. Because, when it comes to investing, everybody, and I mean everybody, has an opinion.
But very few have a truly proven track record, right?
Precisely. We've spent a lot of time synthesizing the foundational principles from the actual masters of the game. We're talking self-made billionaires, Nobel laureates, financial titans.
And we're not digging for, super complex arbitrage strategies or the latest hot stock tip here.
No.
We're looking for the proven, repeatable operating manual. Sort of the blueprint for financial security, independence, and at the end of the day, freedom.
And our sources, they've distilled this wisdom into 7 essential steps. And the really surprising thing, maybe,
Yeah.
we're not starting with some complicated spreadsheet or a mathematical formula. We're starting with what might be the single hardest step.
Which is?
The psychological commitment, the mindset shift required to fundamentally change your financial game.
Okay.
Exactly. We're extracting those core insights that allow you, the listener, to become genuinely well-informed, giving you immediate steps toward financial freedom without feeling completely, overwhelmed by all the complexity out there.
All right, let's dive right in. Okay, so let's unpack this core idea first. Most people, when they think about why they might fail financially, they assume, oh, the strategy I used was flawed, or maybe I just didn't start with enough money.
Right. That's the common assumption. But the masters of the game, they're unanimous on this. Success in life, and especially financial success, it's like 80% psychology.
80%.
80% psychology, and only maybe 20% mechanics, the actual how-to.
Wow. So why is that the ultimate obstacle then, the psychology part?
Well, because you can literally hand someone the perfect investment strategy, a guaranteed map to wealth. But if they're telling themselves a limiting story.
What do you mean by limiting story?
These disempowering narratives we run in our heads, things like, oh, I don't make enough money to possibly save, or the whole system is rigged against people like me anyway.
Or even just, I'm just not good with numbers, it's too complicated.
Exactly. Those kinds of stories. If you internalize that narrative, that belief, well, it becomes a financial self-fulfilling prophecy. You'll sabotage the execution every single time, even with the perfect plan.
So why would you even bother committing to action or studying the mechanics if deep down you already know you're going to fail?
Precisely. The cycle just reinforces itself. It goes round and round until somehow you find the courage to just draw a line in the sand.
And you're saying that breakthrough moment, it's usually not gradual.
Rarely, according to our research. True transformation tends to happen, boom, in a moment when some trigger goes off and you just decide, enough is enough, I'm changing my story right now.
The science behind this, the power of changing your internal narrative, it's actually pretty shocking. You mentioned the research on how we perceive stress.
Yeah, it's a fantastic example, really profound. It shows how your story literally becomes your physical reality. There was this massive long-term study. They tracked thousands of adults, and they looked specifically at those who experienced a high level of stress in their lives.
Right.
What they found was that the adults who experienced a lot of stress, and they also believed that stress was harmful to their health, those people had a 43% increased risk of dying.
Wait, hold on, let me get this straight. The stress itself wasn't the primary killer. It was the belief about the stress that was the deadly factor. That feels really counterintuitive.
It does, doesn't it? But it just highlights the incredible power of our interpretation. See, the people in that same study who experienced an equal amount of stress, but they didn't view it as harmful.
Yeah.
They were no more likely to die than anyone else. It's like they were inoculated against the harm purely because of their internal story about stress.
So you can reinterpret the physical signs. The rapid pulse, the adrenaline.
Exactly. Instead of viewing that as, oh no, I'm panicking, I'm collapsing under pressure, you can choose to view it as your body preparing you, energizing you, equipping you to meet the challenge head on.
Change the story.
And you change the physical reaction. And by extension, you can change your financial outcome too. It all starts there.
Okay, so if that psychological commitment is drawing the line, changing your story from, say, victim to victor, then what's the physical act? the thing that anchors that commitment. The sources call it the most important financial decision of your life.
Right. And that decision is simple but profound. You have to decide to become an investor, not just a consumer, meaning you have to fundamentally change that terrible trade most people make every single day.
Which is?
Trading their time for money. Look, you can always figure out ways to get more money, right? But you can never, ever get more time. It's the ultimate finite resource.
Okay.
So to break that cycle, you absolutely must decide what percentage, what portion of your paycheck you are going to keep for yourself automatically before you spend a single dollar on rent, groceries, anything.
Has to be the first thing that happens. Non-negotiable.
Absolutely non-negotiable. And that one decision, that commitment, leverages the single most powerful force in the entire financial universe.
That's good compounding, right?
Compounding. For anyone listening who isn't quite convinced yet about its sheer raw power, let's just look at some historical evidence the sources share. It's pretty compelling.
Okay, like what?
Well, take the famous Benjamin Franklin bequest. You know the story.
Vaguely. Remind me.
When he passed away back in 1790, he left the equivalent of about $1,000 each to the cities of Boston and Philadelphia. A decent sum then, but not astronomical.
Okay.
But here was the catch. The money had to be invested, and it couldn't be touched for the first 100 years. And then most of what was left couldn't be touched for another 100 years.
Wow. Okay, so 200 years of forced investing, of compounding. What happened?
Well, after 2 centuries,
Yeah.
and just assuming the historical average stock growth rate of around, say, 8% compounded annually, that initial, pretty modest $1,000 gift, it grew to approximately $6.5 million for each city by 1990.
From $1,000. That's mind-blowing.
It really is. Compounding is, well, it's the only sure way to grow that small seed of money you start with into the, the bumper crop you'll eventually need for financial security. It turns tiny incremental savings into truly exponential wealth over time.
And the absolute key, as you emphasized, is making that contribution, that commitment to your freedom fund, automatic. It can't be optional. It can't depend on, what's left over at the end of the month.
Absolutely not. It has to come off the top.
Yeah.
And look, we need to look at case studies not just of financial genius, but of sheer commitment. Consider Theodore Johnson.
Who is he?
He ran the personnel department at UPS. So not some Wall Street wizard.
Right, an everyday guy, relatively speaking.
Exactly. He simply committed systematically to automatically investing 20% of his income, consistently, decade after decade after decade.
And the result?
By age 90, his commitment, combined with the power of compounding, resulted in a personal fortune of over $70 million.
$70 million?
Yeah.
From saving 20%.
Wow. And the beautiful thing is, you don't need a massive salary to start this process. Think about Osceola McCarty. She made national news a while back.
I remember that name.
She was a washerwoman. She practiced what our sources call penny wisdom, just saving consistently, diligently, even if it was just a few dollars here and there over her entire lifetime.
Okay.
By the time she was 87, she had grown her savings enough to donate $150,000 to a scholarship fund.
Incredible. These examples just prove it, don't they? The commitment, the consistency, it vastly outweighs whatever initial capital you start with.
It really does. Ideally, that commitment should be 10% or more of your income. But honestly, the critical first step is just establishing the habit. Just get started, even if it's small.
Lay that portion aside first.
And then build your life around what's left. You cannot even begin to tap into that awesome power of compounding until you make that commitment. That all-important savings piece has to come first.
Okay, so once that psychological commitment is solid, you've drawn the line, you're paying yourself first. The next big step is achieving what the sources call insider status.
Right. Understanding the real rules of the game and, maybe more importantly, recognizing the financial myths out there that seem almost designed to systematically separate you from your hard-earned money.
And myth number 2, hidden fees. This is where the system can get particularly predatory, isn't it?
Oh, absolutely. This is where Wall Street often employs what you might call the math magicians.
Math magicians.
Yeah. The average investor, they look at the sticker price, right? The expense ratio on a mutual fund fact sheet, and they think, okay, my fee is only 1%. Seems reasonable enough.
What?
But the shocking reality, according to deep industry sources, is that the 1% fee you see, it's often only one of more than 10 potential fees and hidden costs.
10. More than 10.
Yes. Costs that are actively pulling you backward down the mountain you're trying to climb.
Okay, beyond the basic management fee, what on earth are we paying for? And why is it so opaque? It feels hidden.
It often is. We're talking about a whole laundry list of hidden charges. You've got things like 12B1 fees.
What are those?
They're effectively marketing costs. You, the investor, are paying to advertise the fund to attract more investors. It's crazy.
Okay, what else?
Then you have trading costs. Every time the fund manager buys or sells a stock, there are brokerage commissions, spread costs.
Yeah.
Those get passed on to you. Then there's cash drag.
Cash drag.
Yeah, the money that's sitting in the fund, uninvested, maybe waiting for the manager to deploy it. It's earning zero return, dragging down performance. And then there are the notorious soft dollar costs.
That sounds sneaky.
It can be. It's where the fund might buy services like research reports from a brokerage firm, and in return, they might pay slightly higher trading commissions on your behalf.
It's not
Complex and not transparent.
So, okay, if we add up all these tiny cuts, these basis points here and there, what's the real damage? What does it actually cost us?
Well, when you look at the total picture, all those fees combined, the average actively managed mutual fund might actually eat up something like 60% of your potential returns over a long investing lifetime.
60%. Are you serious?
Dead serious. It's absolutely astronomical. And the compounding damage, that's the real killer here.
Okay, let's make that concrete. Illustrate that damage with that example from the source is the one with Jason, Matthew, and Taylor.
Perfect example.
Right.
Imagine 3 investors. They all start with the same amount, say $100,000. And let's assume their money grows at the exact same rate, 7% gross annual return before fees.
Okay, same starting point, same growth.
The only difference is their total annual fees. Jason pays 3% all in, Matthew pays 2%. And Taylor manages to keep her total costs down to just 1%.
All right. Fast forward, say, 40 years, a typical investing career. What's the difference in their final account balances?
It's staggering. Jason, paying that seemingly small 3% fee each year, ends up with $324,340.
Okay.
Matthew, paying 2%, does a bit better. He ends up with $432,194.
Still a big jump.
Yeah.
But Taylor,
who paid only 1% in total fees, she ends up with a whopping $574,349.
wow. Okay, so Taylor, who invested the exact same initial amount, earned the exact same gross return. She ends up with nearly twice as much money as Jason, purely because of that 2% difference in fees each year.
Exactly. That is literally the difference between a comfortable, secure retirement and potentially years of grinding anxiety.
That's huge.
It is. As Jack Bogle, the legendary founder of Vanguard, constantly warned, paying these excessive fees can literally result in you giving up 50% to 70% of your future nest egg to the financial intermediaries.
So what's the escape route? How do we avoid these fee factories, as the sources call them?
The path is crystal clear. You must drive your total annual costs, all those explicit and hidden fees combined, down to 1.25% or less on average. Ideally, much less.
And is that achievable for a regular person?
Absolutely. The good news is, today, you can gain ownership of the entire U.S. stock market, say through an S&P 500 index fund, in a low-cost format for as little as like 0.03% or 0.04% in some cases, certainly well under 0.14% that the sources mentioned. The tools are there, you just have to know to look for them and demand them.
Okay, so avoiding high fees is critical. But that desire often runs headlong into the third myth, right? Which is the misleading way that investment returns are often advertised.
Yes. And this directly encourages what we call performance chasing.
Also.
Where you see these fund advertisements, maybe online or in magazines, and they showcase these stellar historical returns, right? Up 25% last year.
Yeah, they look great on paper.
They do. But somehow we, the actual real-world investors putting our money in, we consistently fail to capture those exact results ourselves. There's a gap.
Why is that? Why don't our personal returns match the fund's advertised returns?
It's largely due to a crucial and frankly often intentional discrepancy, the difference between time-weighted returns and dollar-weighted returns.
Okay, break that down. Time-weighted versus dollar-weighted.
Right. Think of it like this. Time-weighted returns are basically the mutual fund's report card. It measures what one single dollar would have earned if it had stayed invested perfectly, without any additions or withdrawals for the entire year or period measured.
Okay, that's the number they use in their advertising.
Exactly. It's the metric the fund managers use to fuel their marketing materials because it usually looks better.
But that's not how we actually invest, is it?
Not at all. You probably contribute regularly through your 401k or IRA, right? So money is flowing in throughout the year. Or even worse, sometimes people chase performance.
Meaning they see a fund had a great year, so they dump a large chunk of money in after the big run-up.
Precisely. Or they panic and pull money out after a crash.
Okay.
So your actual return, the one that reflects your real-world experience, is the dollar-weighted return. This is the reality check. It accounts for the actual flow of your money, all your contributions and withdrawals, and, crucially, when those cash flows occur.
And because most investors tend to buy high after good performance and sell low after bad performance.
Their dollar-weighted returns consistently and often significantly lag behind the advertised time-weighted returns. And this difference, this gap, it helps fuel the misleading narrative that active management, picking stocks, timing the market, actually works consistently.
But the hard data, the evidence, it just doesn't back that up, does it?
Emphatically no. We know from decades of research, like the SPI reports, that something like 96% of actively managed mutual funds fail to beat their simple market benchmark index.
96%.
Over any sustained period, like 10 or 15 years, they fail, yet they continue to charge those huge fees we just talked about.
So you're effectively paying, what, 30 times more in fees for a statistically guaranteed inferior performance compared to just buying a cheap index fund?
That's pretty much the bottom line. The system, especially in traditional brokerage models, is often designed to reward the manager and the firm, not necessarily you, the end investor.
Okay, that leads directly into the fourth myth, which feels perhaps the most dangerous because it really deals with trust.
Absolutely. Trust is the foundation of any financial relationship.
And most people, I think, instinctively believe that their investment person, the one with the fancy title like wealth advisor or financial consultant, they assume that person legally has their best interests at heart.
And that very natural assumption, that's often where financial catastrophe can begin. It is absolutely critical, vital for listeners to understand this distinction. Most traditional brokers, who are technically called registered representatives, they work for large firms, and those firms often reward them, sometimes very handsomely, for selling specific products, usually the ones that are most profitable for the firm, which are not always the best or lowest cost option for you.
So their incentive isn't necessarily aligned with mine.
Not always. They operate under what's called the suitability standard. This means the investment recommendation only needs to be suitable for someone of your age, goals, and risk tolerance. It doesn't have to be the absolute best or lowest cost option available in the entire market.
Wait a second. So my financial advisor might not be legally required to act in my best interest. How is that even legal? What loophole allows that kind of fundamental conflict of interest?
Well, the term advisor itself isn't as strictly regulated in that context as you might think. Their primary legal duty often is to their brokerage firm, their employer, and their compensation structure is frequently based on commissions from selling products.
Which creates an immediate and, frankly, potent conflict, right?
A huge conflict. You absolutely must understand the crucial difference between that model and a true fiduciary.
Okay, define fiduciary for us.
A fiduciary, typically this would be an independent registered investment advisor. An RIA is legally and ethically bound 100% of the time in all transactions to act solely in the client's best interest, period.
No wiggle room.
No wiggle room. Their interests must be aligned with yours. They are typically paid a transparent fee directly by you for their advice, not hidden commissions for pushing particular products.
And the danger here isn't just about paying slightly higher fees, is it? It can be about catastrophic risk, especially in a crisis. The sources cite the Enron collapse as a really painful case study.
Yeah, Enron illustrates the danger of this conflict just perfectly. Think about this. 9 months before Enron declared bankruptcy, when surely internal red flags were waving frantically,
You'd think so.
major respected Wall Street brokerage firms continued to publicly recommend buy or hold on Enron stock. They kept those positive ratings right up until the stock had, well, literally nothing left to hold on to.
Because recommending sell would hurt their firm's investment banking relationship with Enron or other business interests.
Exactly. The inherent conflict means that in times of real market stress or corporate crisis, your advisor's firm's interest might very well come before your financial safety. And that can potentially wipe out years, even decades, of your hard-earned savings.
So if you take just one step from this section to really solidify your position as an insider, what should it be?
Find out unequivocally if the person giving you financial advice is operating under the fiduciary standard at all times. Ask them directly. Get it in writing. Aligning yourself with the true fiduciary who provides transparent, conflict-free advice is probably the single most important defensive move you can make.
Okay, so we've built the psychological foundation, we've debunked the myths, we know who to trust. Now we shift from playing defense to playing smart offense. we land on step 4, which our sources universally call maybe the most important investment decision of your life.
Yeah, this is the big one. Asset allocation.
And you're saying every expert, from Nobel laureates to top hedge fund managers to self-made billionaires, they all pointed to this.
Every single one we researched emphasized this. Asset allocation, they said, was the key to successful, sustainable investing over the long haul.
So what is it exactly, in simple terms?
Well, asset allocation is really just the art, and maybe a bit of science, of dividing up your investments into different categories or buckets.
Buckets, okay.
Yeah, based on their purpose, your time horizon for needing the money, and crucially, their risk profile, how much they tend to bounce around. If you master this one concept, you not only learn how to potentially become wealthy, but maybe even more importantly, how to stay wealthy and actually sleep well at night.
All right, let's look at the 3 core buckets that the sources use to structure this strategy. What's the first one?
First, and arguably most critical, you absolutely must establish the security peace of mind bucket.
Security bucket.
This is the money you absolutely cannot afford to lose, ever. Its purpose is to provide financial certainty, which, if you think about it, is one of the most basic human needs, right? Security.
Makes sense. So what kind of investments go in this bucket?
We're talking instruments designed primarily for preservation of principal. Things like high-quality government bonds, like U.S. Treasuries. Maybe TPS, Treasury inflation-protected securities, which adjust to protect your principal against rising living costs.
Okay, safe stuff.
Very safe stuff. Traditional bank CDs, we also mentioned market-linked CDs earlier, and potentially certain types of annuities like fixed-indexed annuities, or even the cash value component of certain high-quality life insurance policies. This money is the absolute non-negotiable floor under your financial life.
Got it. Bucket 1, security. What's the second bucket?
Then you designate capital for the risk growth bucket.
Risk growth. Sounds like where the action is.
Well, this is where you intentionally seek greater potential returns. And to get those potentially higher returns, you have to accept the necessary volatility, the ups and downs that naturally come with things like equity markets.
So what goes in here? Stocks.
Equities, yes, stocks, stock mutual funds, ETFs. Also, potentially income-producing real estate, whether that's physical properties you own or things like REITs, real estate investment trusts. Certain commodities can fit here, depending on the strategy, and maybe some specific types of structured notes that offer growth potential. This bucket is really the engine that drives your long-term exponential growth.
Okay, security, risk growth. What's the third bucket?
And finally, there's a smaller but maybe emotionally the most crucial bucket. The dream bucket.
Dream bucket. I like the sound of that.
Yeah. This is typically a much smaller allocation, maybe only 5%, perhaps 10% at most, of your total investable assets.
And its purpose?
It's really twofold. One, it's there to allow you to reward yourself along the journey. And two, it provides that kind of emotional juice. It funds those shorter-term or medium-term goals and dreams.
Like what?
That dream vacation you've always wanted to take. Starting that personal passion project you keep putting off. Funding a new hobby. You need to live fully while you're building wealth. Don't just wait until you're 80 years old to finally enjoy the ride, right?
Good point. Investing isn't just about some far-off finish line.
Exactly. It's about making the entire journey richer and more enjoyable. That dream bucket helps you do that. Hashtag tag 3.2 asymmetric risk reward. Upside without the downside.
Okay, so we have these 3 buckets. What's the overarching philosophy that guides how much goes where and what kind of investments we choose within them? You mentioned Warren Buffett's famous rules earlier.
Right. It all comes back to Buffett's 2 most critical rules for investing. Rule number 1, don't lose money.
And rule number 2.
See, rule number 1.
Okay. But why is avoiding loss so paramount? More important than chasing gains?
Because the math of losses is just brutal. Think about it. If you lose 50% of your capital in a market crash, you need a 100% return just to get back to where you started, just to break even. And that takes time. Invaluable time you can never, ever recover. That opportunity cost is devastating.
Okay, so protect the downside is priority 1.
Absolutely. Which is why the true financial masters, they obsessively look for what's called asymmetric risk reward.
Asymmetric risk reward. Explain that.
It means structuring opportunities where the potential reward, the upside, is drastically disproportionately larger than the potential risk, the downside.
You give an example.
Sure. Think of it like this. You're looking for scenarios where maybe you risk $1.
Okay.
And the absolute worst case outcome is you lose that $1. But the potential best case outcome is that you make $5 or $10 or even $50. You're trying to structure the risk so that any potential loss is strictly limited and small, while the potential gain is significantly larger, maybe even massive.
Finding opportunities with limited downside but big upside potential.
Precisely. And the sources show that the ultra-wealthy, they use specific tools and strategies, often within that security bucket, to achieve exactly this.
Right.
Downside protection, while still maintaining exposure to potential market upside.
Like those market-linked CDs you mentioned.
Exactly. Market-linked CDs are a prime example. They're typically FDIC insured up to the limits, which makes them extremely safe from a principal standpoint.
Right.
And they usually offer maybe a small guaranteed minimum return, plus they give you participation in some of the upside of a market index, like the S&P 500. But here's the key asymmetric part. If the market falls during the term,
you lose nothing.
You lose nothing of your principal. It's protected. Yeah. That's asymmetric thinking in action. We saw an example of an advisor who used these types of principal-protected instruments.
Yeah.
And was able to average around 8% annually for clients while providing 100% principal protection. Even during the absolute carnage of the 2008 market meltdown, when the S&P 500 lost, 37%? His clients with this strategy didn't lose principal. That's truly storm-proofing your money.
That's incredible peace of mind. What about those other tools, structured notes and fixed indexed annuities? How do they fit the asymmetric profile?
Well, structured notes are somewhat similar conceptually to market-linked CDs, but they're typically riskier because they generally like FDIC insurance. You're essentially lending money to a major investment bank.
Okay.
However, the better ones are designed to offer 100% principal protection at maturity while still allowing you to participate in potential index gains, maybe with a cap or participation right. It's a more sophisticated tool, often used by the ultra-affluent, again, to get upside exposure without risking the initial principal investment.
And the fixed indexed annuity, FIA, you said earlier, they often get a bad rap, but can belong in the security bucket if structured properly.
Yes, absolutely. Look, annuities can be complex and sometimes expensive if not chosen carefully. But a well-designed FIA from a highly rated insurance company can offer a powerful combination.
Which is?
100% principal protection guaranteed by the claims-paying ability of the insurance company. 2, the potential to earn interest based on the positive performance of an external market index, like the S&P 500, often up to a cap or subject to a participation rate.
And the key benefit?
When the index goes up, you get credited interest, often locking in those gains annually. So if the market then drops 30% the following year, you don't lose anything. You simply keep the gains you locked in during the previous good years.
So you get market-linked upside potential without the downside market risk.
Exactly. And those gains typically compound on a tax-deferred basis. So used correctly, an FIA can provide some of the return characteristics of the risk-growth bucket, but within the safety parameters of the security bucket. It acts like income insurance for a portion of your portfolio. Hashtag 3.3, the all seasons portfolio, Ray Dalio's principle.
Okay, so we understand the bucket strategy and the focus on asymmetric risk. Now, how do we actually determine the specific mix of assets within those buckets? Most people just default to that traditional 60% stocks, 40% bonds portfolio, right?
That's the default, yeah. The classic 60-40. But Ray Dalio, the founder of Bridgewater Associates, one of the most successful hedge funds ever, he fundamentally challenges this widely accepted standard.
He argues it's flawed.
He argues that relying solely on 60-40 is basically relying on hope, not on a robust strategy.
But hold on. 60-40 is still the bedrock of countless retirement accounts and target date funds. Isn't Dalio's alternative, which includes things like commodities and long-term bonds, maybe overly complicated for the average listener to implement?
That's fair skepticism. And yes, it's a bit more nuanced than a simple 60-40 split. But the complication is necessary, Dalio argues, because that traditional 60-40 model is actually not balanced in terms of risk.
How so? It sounds balanced 60% one thing, 40% the other?
It's balanced in terms of dollars allocated, yes.
Yeah.
But stocks historically have been about 3 times more volatile, meaning 3 times more risky than typical investment-grade bonds.
Ah, okay. So even though it's $60-40, the risk exposure is much higher on the stock side. Maybe like 90% of the portfolio's risk comes from the stocks.
Exactly. So your portfolio's fate is overwhelmingly tied to the performance of the stock market. If stocks crash hard, that 40% in bonds might not be enough to cushion the blow significantly. You're basically just hoping that stocks and bonds don't both tank at the same time.
Which sometimes they do. So What was Dalio's genius insight here? How did he approach building a truly balanced portfolio?
His core philosophy centers on designing a portfolio that can perform reasonably well, or at least survive, regardless of the prevailing economic season.
Economic seasons like summer, winter.
Sort of.
Linda?
He identifies 4 key potential economic environments that drive asset prices. You can have periods of rising inflation, periods of deflation, falling prices, periods of rising economic growth, and periods of declining economic growth.
Okay, those 4 states.
Right. And the goal of his all-seasons portfolio strategy is simple, conceptually, to structure the portfolio so that roughly 25% of the overall risk exposure is allocated to assets that tend to do well in each of those 4 possible environments.
So no single economic reality can completely crush your portfolio.
Yeah.
It's diversified by economic condition, not just asset class.
Precisely. For example, assets like long-term government bonds and cash tend to do well during deflationary periods or declining growth, while assets like gold and commodities tend to offer protection during periods of unexpected or rising inflation. Equities thrive in periods of strong growth.
Okay, I see the logic. So for the average investor who wants to implement this, what's Dalio's specific all-seasons allocation breakdown look like?
Based on his principles adapted for accessibility, the allocation shared in the sources is this: 30% in stocks, like a total stock market index.
Okay, 30% stocks, less than 60-40.
Right. Then 40% in long-term U.S. Treasury bonds.
40%, okay.
Another 15% in intermediate-term U.S. Treasury bonds.
All right, so 55% total in bonds split between long and intermediate.
Correct. And then the last 2 pieces, 7.5% in gold.
Gold,
And 7.5% in a diversified basket of commodities.
Stocks 30, long bonds 40, intermediate bonds 15, gold 7.5, commodities 7.5. That adds up to 100.
That's the mix. And the historical performance proof, based on backtesting this specific allocation, is frankly astonishing.
How did it do?
Over a very long 40-year period, from 1974 through 2013, this all-seasons portfolio delivered nearly 10% annually, about 9.88% per year, net of estimated fees.
Wow, nearly 10% a year is fantastic. But what about the risk? The volatility?
That's where it truly shines. It achieved that return with genuinely extraordinary safety and consistency. Get this. It made money in 85% of those 40 years.
85% of the time it was positive.
Okay, and in the few years it did lose money, only 6 losing years out of 40, the average loss was incredibly small, just 1.47%.
An average loss of less than 1.5% in its down years. That's amazing stability. Let's put that into context against a major crisis. What did this specific all-seasons allocation do in 2008? The year the S&P 500 index lost a brutal 37%.
In 2008, this all-seasons portfolio was down only 3.93%.
Less than 4% down when the market crashed, almost 40%. That's incredible.
It really is. And that stability, that low volatility, provides what the sources call crucial emotional scaffolding for the investor.
Emotional scaffolding. Meaning?
Meaning, when the markets are melting down all around you, like in '08, most investors panic. They can't take the pain. They sell everything near the bottom, locking in catastrophic losses they can never recover from.
Right. Fear takes over.
Exactly. But the all-seasons portfolio's relatively smooth ride, its low volatility, it protects the investor from their own worst enemy, their own emotions. It helps them stay invested, stay the course, and let the power of compounding continue to work its magic over the long term.
Okay, this is great. We've got the essential mindset shift. We know the myths to avoid. We have a robust, low volatility allocation strategy like all seasons. Now let's turn to section 4. How can we actively accelerate the journey to financial freedom? Make it happen faster.
Right, because just setting the strategy isn't always enough if the timeline feels too long. The first and maybe most straightforward way to speed things up is remarkably simple, but it requires that fierce commitment we talked about earlier.
Which is?
Save more money and ruthlessly cut unnecessary expenses.
The basics, but powerful. Hashtag 4.1. Speed it up by saving more and cutting expenses.
We absolutely have to focus on what financial expert David Bach famously called the latte factor.
I have the daily coffee habit idea.
Exactly. But it's really just a metaphor, right? It represents all those small, seemingly insignificant, daily, often unconscious purchases that we make that compound into massive financial losses over time.
It's not just literal lattes.
No. It's the multiple streaming subscriptions you barely use. It's the constant food delivery fees. It's that $8 artisanal sandwich you grab for lunch every day instead of packing your own. It all adds up.
Give us the hard numbers again on just one of those small daily habits. What's the real cost?
Okay, let's say you identify and cut a $10 a day habit. which honestly is pretty easy to hit these days if you factor in maybe a fancy coffee, plus a couple of those delivery fees or subscription costs averaged out per day.
Right, $10 a day. Seems manageable to cut.
If you take that $10 a day, that's $300 a month, $3,600 a year, and you invest it instead. Even assuming a pretty modest 6% average annual return, that seemingly minor $10 a day habit will cost you over $141,250 in lost savings over just 20 years.
$141,000.
Yeah.
Gone.
Yeah.
Just on small, unconscious spending. That could be a massive down payment on a house.
Exactly. Simply frittered away on convenience or small daily indulgences. But look, while cutting the small stuff is important, the truly massive accelerated gains often come from tackling the biggest expense categories in most people's budget.
Like housing and transportation, right?
Absolutely. Housing is usually number one. Think about your mortgage. You can take a standard 30-year mortgage and functionally cut the duration almost in half, effectively turning it into a 15-year mortgage.
How?
By making extra principal payments? Yes. Simply by prepaying a relatively small extra amount each month. On, say, a $500,000 mortgage, prepaying just an extra $270 per month towards the principal. That small action can save you hundreds of thousands of dollars in total interest payments over the life of the loan and shave literally years, maybe over a decade, off your debt timeline. That frees up massive cash flow sooner.
Wow. And transportation. Cars are another big one?
Huge. The sources share a story about someone's son who was driving a fancy BMW, pouring money into payments, insurance, premium gas.
Yeah.
He was encouraged to radically change his car habit. Trade in that status symbol luxury SUV for something much less expensive, reliable, maybe used. That single move instantly freed up hundreds and hundreds of dollars every single month, money that could then be immediately rerouted into his freedom fund, into investments.
So challenging those big lifestyle-driven expenses can have a huge impact quickly.
Massive. And for those listeners seeking truly radical acceleration, the sources suggest considering major lifestyle optimization, often achieved through relocation.
Moving. Like to a different city or state.
Yes. This can be like pouring rocket fuel on your savings rate. Think about deliberately moving from a high cost of living area, like maybe the Bay Area or New York City, to a lower cost of living area, maybe in the Midwest or the South, or even just a less expensive city within the same state. Or consider moving to a state with zero state income tax.
What kind of impact can that have?
The sources cite real-world examples. Moving from a super high-cost city like San Francisco to even another major attractive metropolitan area like, say, San Diego, that alone could potentially cut your housing costs by something like 32%.
32% just on housing.
Right. A single strategic relocation like that could result in an effective 10%, 20%, even 30% increase in your disposable income almost overnight, without having to ask your boss for a single penny raise.
And all that extra cash flow
Is immediately available for investment. If you are managing to save, say, 10% of your income before the move, a single relocation could potentially boost your savings rate to 20%, 30%, maybe even 40%, instantly accelerating your path to freedom. Hashtag 4.2, speed it up with tax efficiency. Roth and PPLI.
Okay, saving more is huge. What's the second major way the sources say we can accelerate the journey?
Making sure that all that wonderful exponential growth you're working so hard to achieve isn't ultimately crushed by the tax man down the road. Tax efficiency is key.
And why is that particularly important now?
Well, look at the realities. Given the historical levels of government debt, we're talking $17 trillion just based on the source material, and it's higher now.
Right, the debt keeps climbing.
It seems highly probable, almost inevitable to many experts, that future tax rates will likely need to be significantly higher than they are today to deal with that debt burden.
Which makes paying taxes now, while rates might be relatively lower, potentially a very smart move.
Exactly. Which leads directly to the power of the Roth structure for tax certainty.
The Roth 401k or the Roth IRA?
Yes. The fundamental advantage is simple but incredibly powerful. With a Roth, you contribute money after you've paid taxes on it today, but then all the growth, all the earnings for decades, it grows 100% tax-free, and qualified withdrawals in retirement are 100% tax-free forever.
So pay the tax today at potentially known lower rates.
So that when your investments have hopefully grown significantly larger years from now, you keep the entire amount, the whole 7%, 8%, whatever your return is. You don't have to suddenly hand 30%, 40%, maybe even 50% of your nest egg back to the government in future, potentially higher taxes.
That feels like one of the most powerful and accessible tools the average investor has to guarantee their future wealth stays theirs.
It really is. Maximize those Roth contributions if you can. But for the ultra-affluent, the high-income earners, the sources reveal there's an even more powerful, completely legal, IRS-approved tool for tax efficiency. One the New York Times famously called the insider's secret.
Okay, now you've got my attention. What is it?
It's known as private placement life insurance, or PPLI.
Life insurance. How does that accelerate wealth?
Well, it's not really about the death benefit, although that's part of it. PPLI is essentially a sophisticated institutional strategy. It allows high net worth individuals, typically those meeting accredited investor standards, to invest substantial sums of money.
Okay.
Often into complex, potentially high return alternative investments like private equity or specific hedge fund strategies. But they do it inside the tax sheltered wrapper of a life insurance policy chassis.
Okay, so how does that wrapper achieve such a massive increase in wealth? You mentioned a 400% potential increase in the outline. We need to understand the mechanism there.
Right. The mechanism, while complex in setup, boils down to combining two massive, well-established tax advantages inherent in life insurance contracts. First, the money invested inside the PPLI policy grows 100% tax deferred.
So no annual tax drag on dividends, interest, or capital gains as it compounds.
Exactly. That avoids the significant friction of annual taxes that can really eat away at compounded growth over many decades. That alone is huge. But second, and crucially, when structured properly according to IRS rules, the money, including all the growth, can typically be accessed later in life, completely tax-free via policy loans against the cash value.
Tax-deferred growth and tax-free withdrawal. That sounds powerful.
It's devastatingly effective over the long term. You essentially bypass almost all the tax friction that normally erodes investment returns over time.
Okay, let's run those numbers again from the example. How does it lead to that 400% difference?
All right, the source example used a hypothetical 45-year-old male. He contributes $1 million into an investment portfolio over 4 years. Let's say it earns a solid 10% average annual return.
Okay.
If that money is invested in a standard taxable brokerage account subject to annual taxes on gains and dividends, after 40 years, that initial $1 million might grow to around $7 million, roughly. Still great.
$7 million, good result,
right.
But with PPLI.
But if that same $1 million was contributed to the same investments held inside a properly structured PPLI wrapper, because of the tax deferral and tax-free access, the ending balance after 40 years could potentially grow to over $30 million.
$30 million versus $7 million, from the same initial investment and same gross return.
Yes, a potential 400% increase in spendable wealth, purely due to tax efficiency and avoiding that annual tax friction over decades.
Wow. Now, obviously, PPLI is a complex tool primarily for the ultra-affluent, right?
Absolutely. High minimums, complex structure, needs expert advice. But it serves as a powerful educational benchmark for everyone. It dramatically illustrates just how important the tax structure of your investments is over the long term. And it reinforces why maximizing your contributions to accessible tax-advantaged accounts, like your Roth IRA or Roth 401k, is so essential because they offer that same fundamental principle of tax-free growth and withdrawal, just on a scale accessible to more people. Hashtag 4.3, creating guaranteed lifetime income.
Okay, tax efficiency is another accelerator. What's the third major area the sources highlight for speeding up or maybe securing the final destination?
It's about creating guaranteed lifetime income, because the retirement landscape, as our sources emphasize, has fundamentally, irrevocably shifted.
How so?
Well, traditional pensions, the kind your grandparents might have had,
Yeah.
guaranteeing income for life, they're largely relics of the past for most private sector workers.
Right. They're mostly gone.
So you are now the captain of your own retirement ship. You are solely responsible for ensuring your accumulated savings last for your entire lifetime, however long that may be. And that's a huge challenge, especially since the traditional rules of thumb, like the old 4% rule for withdrawals, well, they're pretty much dead.
The 4% rule is dead.
Yeah.
Explain that. I thought that was standard advice.
It was standard advice originating back in the early 1990s, but it was based on historical market conditions, particularly bond yields, that just don't exist today. The research cited shows that for someone who retired, say, right at the market peak in January 2000.
Okay, bad timing.
Right. If they religiously followed that 4% withdrawal rule, adjusting for inflation, because of the subsequent market crashes and volatility, what's called sequence of returns risk, they would have had a terrifying 71% chance of running out of money completely by 2010, just 10 years into retirement.
71% chance of going broke following the standard advice?
Yeah.
That's horrifying. Broke and old is not a combination anyone wants.
Not at all. So if that traditional strategy is broken, how do we create that reliable, guaranteed income stream that really forms the foundation of true retirement peace of mind?
Yeah.
We have to strategically reframe our thinking about annuities.
Annuities. They get such a bad reputation sometimes, don't they? Often associated with high fees or complexity.
They do often get maligned, sometimes justifiably if they're bad products sold inappropriately. But a well-structured annuity, chosen carefully from a strong company, particularly things like a fixed-indexed annuity like we discussed, or certain types of immediate or deferred income annuities, they can provide something incredibly valuable that almost nothing else can.
Which is?
Income insurance. A guaranteed paycheck for life, no matter what the stock market does or how long you live. They are designed to mitigate longevity, the risk of outliving your money.
Okay, so using annuities strategically for income certainty. This brings us to that specific strategy mentioned, using longevity insurance, which is often a type of deferred annuity, as a smart hedge. How does that work?
Right. Longevity insurance, typically a deferred income annuity or DIA, is a really intelligent way to specifically hedge against the financial risk of living a very long life, say into your late 80s, 90s, or even beyond 100.
How does it hedge that risk?
Well, let's say you retire at age 65. Trying to make your nest egg last for a potentially uncertain 30, 35, or even 40 years of retirement is incredibly daunting, right?
Sure.
Especially managing withdrawals during inevitable market downturns.
Yeah, the uncertainty is stressful.
But what if, at age 65, you took just a modest portion of your total retirement assets, let's say $100,000 as an example, and you used it to purchase a DIA?
Okay.
This DIA could be structured to guarantee a substantial predetermined income stream, but one that only starts paying out much later in life, say beginning at age 85, and then continues for the rest of your life.
So you use a lump sum now to buy a guaranteed income stream that kicks in way down the road.
Exactly. And the potential payout leverage can be significant because the insurance company knows many people who buy it won't live to 85. The example given suggests that $100,000 invested at 65 could potentially yield a guaranteed annual payout of nearly $64,000 starting at age 85 and lasting for life.
$64,000 a year, guaranteed starting later.
Wow. And what's the strategic benefit of doing that? How does that simplify things?
The benefit is massive because it dramatically simplifies the planning required for the rest of your financial assets, the bulk of your portfolio.
How so?
Because now, knowing you have that guaranteed substantial income stream locked in and starting later in life, at 85 in our example, you only need to manage your primary assets to cover your income needs for a much shorter, more predictable period, say from age 65 up to age 85. Just 20 years instead of an unknown 30, 35, or 40 years.
Wow, it shortens your planning horizon for the bulk of your money, reduces the uncertainty. Precisely. It takes that extreme longevity risk off the table for a portion of your funds. This allows you to potentially be a bit more aggressive or growth-focused with your remaining assets during your earlier retirement years, if appropriate, because you know that safety net income is coming later. It's a powerful psychological and mechanical tool for simplifying that complex retirement income puzzle. Hashtag outro.
Wow. Okay, what a truly detailed deep dive that was. We really covered a lot of ground. We started by tackling what might be the deepest obstacle, that psychological commitment, changing your limiting story about money.
Right, getting the mindset right first.
And then we armed you, the listener, with the map. The core strategies for avoiding those toxic hidden fees, finding true fiduciaries who have your back, and implementing a robust, potentially storm-proof allocation like the All Seasons portfolio.
You really should now possess the fundamental knowledge to avoid the most common financial landmines out there, and also how to harness the powerful engine of compounding and proper asset allocation that can genuinely propel you toward financial freedom.
But remember the central thesis we kept coming back to.
Yeah. The true wealth isn't just the final number in your account statement, is it?
No. It's the ability to fully experience life completely on your own terms. That's the real goal.
Which naturally and beautifully brings us to the final and maybe the most essential step in achieving true financial mastery, according to the masters themselves.
Which is?
Giving. Contributing beyond yourself.
Ah, yes. The sources cite some pretty compelling scientific studies on this, don't they?
They do. Studies showing that people consistently report significantly happier moods when they spend money on others, even just a small, modest gift like $5 or $20, compared to when they spend that same amount on themselves.
So giving literally makes you happier.
It seems so. It creates this kind of virtuous cycle. Giving can make you happier, potentially healthier, and more connected. The masters of the financial game, almost without exception, they understand that wealth finds its highest purpose and is ultimately maximized when it's leveraged not just for self, but for the benefit of others too.
Life is ultimately about what you have to give, not just what you accumulate.
Well said. That seems to be the ultimate lesson.
So, to close out today's deep dive, let's maybe connect this mastery of money we've been discussing to the ultimate long-term horizon, the technological future that's unfolding around us.
Yeah, that's a fascinating connection. Ray Kurzweil, Google's head of engineering, a leading futurist, he has this provocative idea.
What's that?
He basically says the central strategic goal for individuals should be to live long enough for the technology to catch up.
Live long enough for the technology to catch up, meaning
Meaning that breakthroughs in areas like biotech, nanotech, AI, they're occurring at an exponential pace now. We're talking about things that sounded like science fiction just a decade ago.
like what kind of things?
Like potentially 3D printing replacement organs on demand, radical advancements in gene therapy to cure diseases, new stem cell technologies that could rejuvenate tissues and dramatically extend healthy lifespan.
Okay, truly revolutionary stuff is on the horizon.
It seems increasingly likely. But these incredible future innovations, which could literally redefine human health and longevity, they're almost certainly going to be capital intensive, at least initially. They'll cost money to access.
Ah, I see the connection.
Right. So by mastering your finances today, by building that robust, long-lasting freedom fund, using the principles we've discussed, you're positioning yourself not just to retire comfortably in the traditional sense.
You're doing more than that.
You're potentially ensuring you have the financial resources, the independence, to actually access and benefit from the limitless possibilities and the cutting-edge advancements that these future technological breakthroughs might offer.
So that financial preparation today, it's kind of the ultimate return on investment in your own potential longevity and future quality of life.
Exactly. It positions you to take advantage of a future where not just wealth, but life itself might be compounding in ways we can barely imagine right now. That's a pretty provocative thought to end on.